Good evening, everybody. Good evening, councillors, members of the public, and council officers. So, welcome to part 2 of our workshop presentations. Tonight, we'll be taking you through a presentation just explaining how we manage our treasury function. So, we'll get into some of the detail there. So, just in keeping with yesterday, just some house rules. If you do need to use the toilet facilities, they are through the double doors across the hallway. If we do have an earthquake, please drop, cover and hold and wait for further instruction. If we do need to vacate the building, please follow instructions. There are 2 exit points. Please follow staff. We'll either go out the main entrance and we'll go across the parking parking lot to the school, or we'll head down towards the library. Because we are live streaming, and because we're live streaming, please do use your microphones. For those that are not familiar with the microphones, please do push the button. When it's a red light, that means that your microphone is live. When it's a green light, that means that you're not live. So please do wait for it to go red. Once you have spoken into your microphone and are finished speaking, please do disengage your microphone so that the green light will go red. Because we are live streaming, if you don't speak into your microphone, viewers can't hear what you're saying. So it's very, very important that you do speak into your microphone. So tonight, just by way of introductions, tonight I'm being supported by Annalise Horn. Annalise is our manager of our financial accounting team, and will be helping me take you through tonight's presentation. So like yesterday, please stop us as we go. Please ask questions. We do have an hour and a half scheduled for this workshop. That has built in lots of time for questions and explanations. So please do stop us. If I don't see that you've raised your hand or want to ask a question, please just wave your hands or catch our attention. So I think it's just going to be far easier if you ask questions as we go. So without further ado, we'll get into the presentation. So I think I just wanted to start on recapping or outlining the financial strategy. So within Council's current long-term plan for 2018 to 2038, the Council has adopted a financial strategy. Now, within that financial strategy, we speak of 3 levers. So behind me, I'm showing the 3 levers. So the 3 levers of the Council's financial strategy is rates, debt, and CapEx. Now, it's represented by way of a triangle, and the triangle represents the levels of service. So as we work through our long-term plans and our annual plans, we're constantly coming back to the impacts of the financial strategy. So you can change one lever up or down, and you can self-correct and you can keep the levels of service the same by changing the other 2 levers. So for example, if you wanted rates to go down, then you can keep your levels of service the same by changing the other 2 levers. So you'd adjust the debt and you'd adjust the CapEx for rates to go down. If you change 2 levers, so example, you wanted rates to go down and you wanted debt to go down, then you have to, you actually then are looking at a change to your levels of service. So you can't adjust 2 levers, self-correct the 3rd lever and expect the levels of service to be the same. So that's pretty much the financial strategy. We have some upper and lower limits in the financial strategy, and as we go through tonight's presentation, you'll see how that governs some of our treasury management. So in terms of our rates, our preferred range is between 3.9% and 4.7%. As some of you will know, many of you in the room will know, our average rates increase for the current financial year is 2.6%. So COVID-19 has led to some unprecedented decisions to keep the rates increase down, and that's actually lower than our preferred limit in our financial strategy. Moving around, our debt. So we have a couple of control limits with, again, a preferred limit. So our net debt for our financial strategy is 200 million, or our Treasury Management policy says that our net debt must be less than 240% of our operating income. However, we have a preferred limit, and this is what we stick to. So this is really our defining limit that we work to, and that is that our net debt is below 200% of our operating income. Moving across to CapEx, we do have upper and lower limits, and our preferred range is between $25 to $35 million.
Good evening, everyone. So let's get into Treasury Management. So what is Treasury Management? Treasury Management is the planning, the managing and the controlling of our cash, our borrowings, our investments in a responsible manner. So if we look at the wheel on the slide, it basically represents the different functions that makes up Treasury Management. So if we just talk through some of those slices. If we start at the top, cash management, that is really staff's ability to reliably estimate our cash inflows and our cash outflows on a daily basis. If we're looking at liquidity management, do we have access to funding when we require it? Debt management, how do we manage and control our debt levels? Optimum utilisation of funds. How do we best use our facilities available to us? Banking relationships. Do we have good relationship with our funding providers and our bankers? And how do we build on that? International funding. So this is less important for us as a council because we operate locally and we have very few interactions with overseas suppliers. And then looking at risk management, this is how do we minimize and manage our risk associated with entering into borrowings and having investments. So that basically encapsulates what is Treasury Management. So council borrows money to build, upgrade and replace our assets within the district. So we borrow to fund our CapEx expenditure. And when we borrow, it exposes us to three principal risks. And the risks are credit or counterparty risk, liquidity or funding risk, and interest rate risk. So as an entity, we are risk adverse. Our focus is to minimize and manage the risk of having the Treasury function and drawing down borrowings. Speculative activities are forbidden for us as an entity. So if we look at some governance frameworks and controls that is monitoring and controlling what we allow to do, we've got quite a number of different legislations. So if we look at that, the Local Government Act, the Local Government Financial Reporting and Prudence Regulations, the Trustee Act. We've got our Local Government Funding Agency, our funding partner, they've got debt covenant reporting. We've got our International Public Sector Accounting Standards. We've got our external auditors, our own Treasury policy, and then quarterly reporting that we do to our Audit and Risk Subcommittee and our Strategy and Operations Committee.
So I think just similar to our presentation yesterday, the key takeout at this point is in terms of our treasury management, we need to stay within the guidance of our policy. But again, it is a heavily regulated area, and we are subject to audit. And we do report to the Audit and Risk Committee as well as the Strategy and Operations Committee, and sometimes we report to Council on our treasury management. So it's heavily monitored, it's heavily regulated. And so we just wanted we wanted to make that point quite clear.
So for the next few slides, we're really going to focus on our Treasury policy. And our Treasury policy is a framework for controlling and managing our Treasury activities and risks within Council. So firstly, our policy tells us who we can trade with. So it tells us who's the counterparties that we can transact with. It tells us what's the credit rating that these counterparties needs to have. What's the maximum that we can borrow or invest or have as interest swaps with that counterparty. And the reason why our policy actually tells us that is to minimize our credit risk. So credit risk is really the risk of our counterparty to the transaction not repaying or providing committed funding to us as an entity. So what this part of the policy do is really limiting our risk of having all our eggs in one basket. So it's really making us spread our risk across a number of counterparties to avoid concentration of risk. Okay, so if we look at the table, I mean, for our counterparties, it allows us to transact with the New Zealand government, and we can have unlimited transactions with them on both borrowings, investments, and risk instruments. Then it allows us to transact with the local government funding agency. That is our main funding provider and only funding provider at this stage. It also has a S&P credit rating that we need to look at when we transact with them. And it allows us unlimited borrowings with the LGFA and a maximum investment of 20 million. If you look at the registered banks, I mean, LGFA is really the counterparty that we use for our borrowings. If we look at our registered banks, we really use our banks for term deposit investments and our interest rate swaps. So when we interact with our banks, we need to make sure that they've got the applicable credit rating from Standard & Poor's that the policy dictates. And we can actually borrow a maximum of 15 million from our banks if required. We can invest a maximum of 60% of our total investments or 25 million with whichever is the greater with one of the registered banks with our term deposits. And in relation to our swaps, we can enter into 50% of our total amount of swaps or 80 million, whichever the greater with one of these registered banks. So it just makes sure that we spread our exposure to our counterparties rather than just using one counterparty to provide us with the facilities.
Thank you, Annalise. I might just add at this point, so just by way of another introduction, for those of you that don't know, so we're also being supported tonight by our Chief Executive, Wayne Maxwell. Just a couple of points that I just wanted to emphasise, and then we'll certainly go to the floor for the questions. So in terms of investments, so our counterparty limits, our investments are really our pre-funding. So I'll be taking you through and explaining to you what our pre-funding actually is. So that's money that we put on term deposits. So those are our investments, is where we start to pre-fund existing loans that are maturing. So we place that money on term deposits. So we draw down the debt, we put it on term deposit. An interest rate swap, we did have a question last night. Please explain what an interest rate swap is. So just for the benefit of everyone in the room and for our viewers as well, so the Council does use what we call interest rate swaps. Our borrowings are done on floating through the LGFA, as Annalise has just said. So an interest rate swap is a contract with the bank where effectively we swap our floating rate for a fixed rate. So we enter into a contract with the banks, several banks, because we do have the limits on our counterparties, and effectively we sign up to a fixed interest rate for a certain period of time. So that means that we borrow on floating, but what we're signing up to is we actually pay the bank a fixed interest rate. They pay us a floating rate. Now we do that for certainty. So when we look at our annual plan or our long-term planning, we do actually have to budget for certainty. So the reason why we exchange a floating for a fixed rate is so that we're certain on what our interest rates are going to be.
May I, Mr. Chair, add a comment? Some people would say, so why don't you just borrow fixed? Because you can do that as well. And actually then you would remove the accounting issue of the revaluations all the time. The reason why you wouldn't do that, it depends on your view of what interest rates will do, and it's a mismatch between the term over which you're borrowing and the term over which you're fixing. Okay, so that might sound complicated, but basically I could borrow some money for 10 years, but I might only want to fix it for the first 5 years and then renew it, because my view is interest rates will benefit me by doing that. Okay, I don't do it as a gamble. I do it because of the expressed views about what interest rates are going to do. So therefore, if we make the call that, for example, interest rates look like they're going down, which in recent years has been the case, you don't want to fix when you borrow long, okay? Because as interest rates are coming down, you will take advantage of being able to fix it at a lower rate by rolling things over at shorter terms. I'd compare it to fixing your home mortgage. Historically, if you look, the 1 or 2 year rates have always actually been advantageous compared to the 5-year rate. You don't gamble with this stuff. You take advice and you make informed decisions, and you'll never get it perfect. But the flip side holds. If you see interest rates starting to go up, you would probably want to fix long so that you can fix it while it's at the bottom. Of course, what you've got to be careful of is the market anticipates that as well and starts to move with it. So you've got to plan your timing very well. But that's a bit of the strategic reasoning behind why you'll borrow floating and then fix it with a swap, is because you see a mismatch in the timings for interest rates, and you look to maximise the benefit to our borrowing profile.
Sorry, Kathy, we will come to you. Councillor Buswell has signalled that she has a question.
I don't know if it's all that relevant, but just going forward, we've got some Crown infrastructure projects potentially being funded, and we've got the Gateway potentially being funded. And with the elections coming up, if the government changes, does that mean that potentially that loan or funding is at risk of being pulled?
No. Now, that said, we haven't signed anything with anybody on any projects like that, but that will be a contractual arrangement. So obviously, if elements that are a grant, nobody will come away and say, give me that money back. Elements that were in advance by way of a loan, all the guidance we've been given is no party that takes power will undermine that legal agreement.
Okay.
It would cost them to buy their way out. Okay. I think it's reasonable to say that everybody sees the same need and opportunity. Whilst they might say we would deliver things differently, I don't think they'll go so far as to upset the apple carts that are in place.
Okay, thanks.
Kathy, you indicated you had a question.
It just sounds like juggling balls in the air to me. But just wondering if this Treasury policy actually works and with around managing your activities and your risks, and have you ever come to a place where that risk is getting a bit risky, or do you manage to, does the policy work well with managing all these risks?
Thank you. That's a very good question. So yes, the Treasury Management policy does work. And it works for a good reason, as it guarantees very prudent management of our borrowings, and it's also supported and complemented by a financial strategy. So in terms of the policy, we are required to review our policy. Within every 3 years, we must review the policy, or more frequently if required. And it just so happens that on Thursday, what will be tabled with the Strategy and Operations Committee is some proposed changes to the Treasury Management policy. So it's constantly reviewed, and our Treasury Management policy does work. It does allow for, the Treasury Management policy does allow for self-corrections. Sometimes it's not always possible to respond to comply with the policy. So market conditions may change very quickly, and that means we breach our policy parameters. The policy does allow for self-correction within 90 days. It does also provide that we do need to report breaches to our Audit and Risk Committee as well as our Strategy and Operations Committee, which we do. But fundamentally, the short answer to your question is that Treasury Management policy does work.
What some people will tell you is, but you could borrow much cheaper today. So all the debt that we've got, if we borrowed it today at today's interest rates, would be the cheapest anybody's ever seen. And our Treasury policy does not allow us to keep all of our debt floating in order to maximise that rate today, because that is speculation. Because there's no way you can anticipate You tell me who anticipated COVID and the impacts that it's having on official cash rates anywhere. So when we say yes, it works because it requires us to be prudent. And as I mentioned yesterday, the key thing is that we might not get the very maximum benefit out of low interest rates today unless we happen to be able to roll over all of that fixing. And we would never do that. We would never have it all rolling over at one time. That's a concentration and a risk issue. So we will never get the benefit of the very bottom, but nor will we suffer the problem of the highs. And that's the really important thing to remember, is that anybody who tells you they could have done better today, I would have a real issue with, because I know for sure that they could not have told me even a year ago what we would be looking at today. And that is why all of those financial frameworks and legislation that rules what we do is there for a reason, and we have a prudent policy. And I think the key thing is that when we're reviewing our policies, even in COVID, we haven't identified things that need to change as a result. So, and you've got to be really careful that you don't take a knee-jerk reaction and go, oh gosh, it'd be really good to all be floating today so I could take advantage of that, so I'm going to change the policy. That would be a very, very bad move for the obvious reasons. So I think the fact that our policies don't need substantive change, even as we've learnt new things, is a really healthy sign.
Councillor Buswell, you have a question?
I don't really have a question. I have more of a comment. Would it be fair to... Well, it is a question. Would it be fair to say that on our balance sheet, we actually have a line where we make money in terms of the swaps and things like that, like in the vicinity of a few $100,000 a year? I mean, to me, that is bottom line proof that our Treasury policy works. Is that right?
So thank you for the question. So look, as we saw last night, in terms of what we show on the balance sheet, we're showing the fair value of our derivatives, and that goes up or down, and it flows through to the profit and loss. But in terms of what you're asking for, in terms of making money, it's what we call the arbitrage. So where we can borrow, in terms of our pre-funding program, where we can borrow money at a certain interest rate, and we can actually put it on term deposit and actually make a net return. And that's what's called an arbitrage. And that is represented in our Statement of Comprehensive Revenue Expense. So we record all our interest income and our interest expense. So that helps to reduce our net cost of interest. But in terms of the balance sheet, that is just the value of that, was the fair valuation of our swap portfolio. But where we show whether we're making money or not, that's sort of shown in our Statement of Comprehensive Revenue and Expense.
I'll add a different perspective on it for you, if you like. That in the last 4 years, I think our borrowings has gone up by about $12 million for 148 to 160, something like that. They'll give you the real numbers soon. Our net interest cost hasn't changed. So I would point to that and go, so even as there's been a 10% increase in our debt, our net interest cost has remained pretty static at just under $8 million. And I think that's good for ratepayers. So it hasn't seen a rates increase as we've had to borrow more for our CapEx program. We've benefited from a lot of things, which is trying really hard not to have to borrow more. But when we have had to borrow, we've managed to take advantage of those rates as they're coming down. And that's a good thing. Ironically, as I said yesterday, if we had a massive CapEx program and we were borrowing $50 million a year, our average interest rate would look a lot lower because we'd be borrowing today at these rates. We haven't had to borrow a lot. We sort of tapered it off really quickly, and we haven't been able to take advantage of rolling that over in a rush. We have to spread it out over those sort of next 5-10 years. So. But I take it as the starting point is it's good that we've managed to hold our net interest costs even as debt has gone up.
And just in terms of the question from Councillor Halliday, yes, our net interest costs is our interest costs less our interest income. They're both separate lines, but when we talk about net interest cost, we're deducting one from the other.
Good. So first, the policy told us who we can transact with. The second thing that the policy tells us is for how long can we actually borrow? So what's the term of our borrowings? we call it maturity buckets. So if we look at our maturity periods, it basically tells us you need to have borrowings in place that for 0 to 3 years of maturity in your whole portfolio of debt, there should be borrowings of a minimum of 10% that matures within 3 years, or a maximum of 70%. And then it takes you through the 3 to 5 years, the 5 to 10, or the plus 10. So the reason why the policy actually give us these buckets is to minimise our liquidity risk. So liquidity risk is the risk that council does not have the ability to access funds when we require it. So our current strategy is really to have debt maturing every 6 months, so that's twice a year. And when the debt matures, that it's no more than 25 million in a tranche. So what we're basically doing to minimise our liquidity risk is to spread and smooth our debt maturities and the maturity values of each one of those maturities. So it enables us not to get to a point where at any point in time we need to refinance or repay 70 million of debt. It gives us the ability to really control and manage that risk by knowing it's every 6 months, and it is only to a limit of 25 million at a time. With looking at our maturity buckets that we just shown and on the previous slide, this is really showing you what we are reporting back to our Audit and Risk Committee every quarter. So we report back, this slide was the 30th of June's report back to Audit and Risk, and it basically just shows us, this is the different maturity periods, 0 to 3 years, 3 to 5, 5 to 10, and greater than 10, and how much of our borrowings are falling into each one of those buckets. So for example, if we're looking at the 30th of June and the 0 to 3, we sat around 60% of our borrowings sitting in that maturity period, and the minimum for that limit is 10%, and the maximum for that bucket is 70%. So we're actually within the limits of what the policy is saying, and then you can just apply it to each one of those lines within the graph. And as Mark was saying, if we do breach our policy, it is something that we need to report back to the committee.
So what we're seeing there is that, What we're seeing there then is the 5 to 10 year debt's coming down as it's maturing. Is that right? Some 6 month brackets, and it's being put into the 3 to 5 year bracket at today's rates. Would that be right?
So it's not as much maturing. So the ones that would mature is within the 0 to 3 year period. So those are the ones that we will have to repay to the LGFA. What happens with the other categories is just rolling into the next time period. So, for example, if they were sitting in the 5 to 10 period, as time goes on, they will just start falling into the 3 to 5 year period.
Right, gotcha.
And that's just where we need to be quite careful in looking at our limits. And when we draw down debt, we need to be specific about our maturity dates, that we can still comply with our policy. Yes, we acknowledge that short-term debt is definitely cheaper than longer-term debt, but it forces us into a discipline to actually not just draw down debt for short-term in the 0 to 3. We need to look at the 3 to 5, 5 to 10 to comply with the policy.
So just to add, to potentially add to what the Chief Executive was just saying. So I think what Annalise has established is, so when we look at our, so we've got limits on how much of our debt can mature at each time, and we look both backwards and both forwards. So what you're actually seeing is, in terms of when we're looking at, we're managing our treasury function, we'll look at each month and we'll say, of our total debt, how much is maturing within 0 to 3 years, 3 to 5, 5 to 10. So going to your specific question, Councillor Halliday, so in January 2020, what that is actually showing is it's showing that of our total gross debt, we've got that amount is we've got 20% of our total loan book is maturing between 5 and 10 years. The policy says that you must have more than 10%, but you must have less than 50%. So it's just looking at, we stand at different points of time and we look at our total loan book and we make sure that our maturity of those loans are compliant with our Treasury Management policy. And just to echo what our Chief Executive was saying, is you'll see that actually right now with interest rates being low, we don't borrow long. We actually borrow short, and that's why you can see the blue is actually much higher because the interest rates on short-term borrowings is far better, far more attractive, better for the community. So at right now our strategy is to borrow short, not long.
And at the same time, not fill up the toolbox in the short. Because who knows, you need to plan for tomorrow as well. So you've always got to have a little bit of capacity and headroom to be able to deal with whatever else comes at you. So it is a continuous balancing act about what's the right place to be at the right time. And again, reiterating some of the uncertainties that you have mean it's good to have a policy in place to force you to consider certain things.
So this is a chart that we, as Annalise said, this is a chart that actually appears in our reports to the Audit and Risk Committee. So liquidity funding risk. So so what I'll do is I'll take you through this slide, but Annalise has actually already told you what liquidity funding risk is. So it's the risk of us effectively not being able to get any debt funding. So we have existing debt that has a maturity, so we have to refinance that debt, and we also have a CapEx program. So if you think back to our opening slide on the financial strategy, we had the little CapEx, which is one of the three levers of our financial strategy. So it's between 25 and 35 million. So we'll borrow money to finance that CapEx program. So we need to be able to access lending for that, and we've also got debt that's maturing which we need to refinance, because if we were fully repaying that down, our rates would be far higher than what they are today. So that's the risk of us not being able to access funding. As we've said before, that a local government funding agency is our primary source of debt. That's where we get all our money. It was created to provide councils with least costs and to provide us with guarantees to be able to access funding or debt. So we have a Treasury Management policy that allows us to pre-fund up to 18 months in advance of debt maturing. So effectively what that means is, and it's probably best if I actually look towards the presentation on it, can explain it to you better through a picture. A good picture is better than 1,000 words. So what we're showing you here, this chart is our debt maturity and pre-funding is at the 30th of June 2020. So in October 2020, so in October this year, we have $20 million of debt maturing. So what the red bar is showing you is that we fully pre-funded that. So over the last 18 months, we've been actively pre-funding that. So we've been borrowing money. We've been borrowing up to $20 million, and we place that on term deposit in the bank. So the impact that it has is our net debt doesn't go up at all because our gross borrowings goes up. That's recognised as a liability on the balance sheet, but then we place that money on term deposit, which is recognised as an asset. So the two offset each other. So there's no impact. There's no increase in net debt whatsoever. So we put that money on term deposit, and right now, in terms of what's happening in the market, we are actually making a gain, and that's shown on the Statement of Comprehensive Revenue and Expense. So we're giving ourselves surety that we've got the money in the bank to refinance. Now, liquidity risk is also, it's the risk of not being able to access debt at preferential rates and maturities. So it gives us a little bit of it gives us an ability to not be beholden to the market, because we go early, we pre-fund, so we know we've got the money in the bank, we know we can refinance. So that's effectively a transaction that's already done. So if there's something that's happened in the market where the rates are suddenly a lot higher, We don't necessarily, we're not in a position where we have to take on very expensive debt to refinance. So that's our pre-funding. And as you can see behind me in the chart, so we're always looking forward 18 months, and we're always looking to see what we can pre-fund. Now, just because the policy says we can pre-fund up to 18 months in advance, it doesn't necessarily mean that we do. So we look at what's happening in the market, and we make sure that we're making decisions that benefit our ratepayers.
So just from a practical point of view, for us working with the maturing debts, in October when that 20 million of debt matures, it's really us contacting the bank that's got that term deposit, making sure that they pay that term deposit out in the morning, and then for us to pass that money on to LGFA for the repayment of that borrowings. So we've got certainty around that money coming in and then flowing out.
So in terms of this slide, so this is actually showing, so our net debt is our gross debt less our pre-funding program. In other words, the money that we've got in term deposit. And so what we're showing here is a couple of things really. So the dark blue bar is our gross debt, and the light blue bar is our term deposits, our cash in our term deposits. And so when you take the gross debt and you take off from that the term deposit, that's what gives us our net debt. And the green line, so the green line represents the difference between the two. So you can see that our net debts at January was just under 160 million, and we finished in June 20 at approximately 158 million. So that's just the gross debt less what we've got on term deposit and cash in the bank, so which is mainly our pre-funding program. And this particular slide is actually just showing the major control limit in the financial strategy that I kicked tonight off with, which is your net debt must not go over $200 million. However, what I also said is we've got a preferred limit when we manage our borrowings, and that's that our net debt does not exceed 200% of our operating revenue. So strictly speaking, we should also have our green line scattered on there, but I think that comes up a little bit later.
Did you really have to call it green line? That's going to confuse everybody. We love the colour green. So an important point to note here is a lot of people who have done a little bit of analysis of our financial statements have said your gross debt is really bad. And they're using that number to measure our debt per capita or our debt per ratepayer. Sometimes people intentionally only ask for that number so that they can use that number because it looks bad. I don't know why those people would want to do that. I can't imagine. So it is really important for you to understand that we have a very active pre-funding strategy, and the impact of that is quite significant, and that what's really important is our net debt. All elements are important and must be measured and managed, but our net debt is the key thing. That is our obligations to our community in total. And as I say, hasn't really changed in the last few years.
Just to give you a little bit of a sense of the size of our pre-funding program, as at 30th of June 2020, our pre-funding was $45 million.
So the next risk that we actively manage as a council is our interest rate risk. So we've got the ability to borrow money, but unfortunately with borrowing money there is the associated interest cost. So interest rate risk is really the risk that council will be exposed to changes in the market interest rate. And the real risk for us, as previously said, is that the increase in market interest rates is significantly higher than our adopted annual plan and long-term plan finance cost. And that will really cause us to make the decisions around our work program and what we can do. So if our interest costs significantly increase in what we've budgeted, we'll have to start reprioritizing work that we need to do or just stop doing things because that cost we can't avoid. We need to still pay it because we're locked into those borrowings. So that is really the real risk for council, is trying to manage that interest expense that we need to pay. So as we said previously, all council's debt are on floating rates, as lower interest rates can be obtained. And then we fix that interest rate by entering into an interest rate swap. And then without that hedging, it would be really hard for us as a council to absorb adverse increases in our interest rate risks. So at year end, we've got borrowings of 215 million, our total gross borrowings. And if we've got a 1% increase in our borrowings, it will be another 2.15 million of interest costs that we need to pay as a council.
That's if there was a 1% increase to interest rates. That's what we'd be paying. Yep.
But conversely, the other side is also true. So if we fix our interest rates, it does, however, reduce council's ability to benefit from falling or lowering interest rates and favourable movements. But the objective of the Treasury strategy is really to smooth out the effects of interest rate movements for the organisation. So when we look at the accounting for interest swaps, that generates quite a lot of interest because we need to display that in our financial statements. So every month, council is required by the accounting standards to fair value our interest rate swaps or our derivatives, that's the other term that we also use for it, against swaps within the market. And that creates an entry in our accounting records. And that entry can be an unrealised gain or an unrealised loss. So you've got an unrealised gain when your swaps was obtained at a rate lower than what's currently available in the market. And you've got a loss when you obtained your swap at a rate that's more expensive than what's currently available in the market. So if we can look at how that looks like on our statement of on our financial statements on the next slide, please, Mark. So for the full year ending 30 June 2020, you could see the highlighted line on our statement of comprehensive revenue expense. And it basically tells us that we've got an unrealised loss on the revaluation of our derivatives of 6.9 million. So it is something that we need to show in our financial statements. We are required to do that in accordance with the accounting standards. But it's not a real loss, it's an accounting entry, and there's no intention for us to prematurely exit those contracts and cause us to pay that money. What we've got on the right of the slide is also to show you how this happens and how we actually get into the situation where we've got unrealised gains or losses. So we've got the New Zealand swap curve. And as you can see, the first line at the top, that was the 30th of June 2015. And then the green line at the bottom is the 30th of June 2020. And that curve definitely has flattened and it has dropped significantly. So if we, in June 2015, decided to take out a swap for 10 years, we probably looked at a rate of around 3.9% for a 10-year swap. So fast forward to 30 June 2020, where we now, we need to go and value that swap, and we compare it to 10-year swaps in the market currently. So the 10-year swap in the market currently is now sitting at 0.75%. And that difference between the red line and the green line is causing that unrealised loss that we need to then reflect in our statement of comprehensive revenue and expense.
Thanks, Annalise. If I can just add to that, and I just know Wayne's going to add a few more comments. So you may have heard economists, they love to talk about the steepening of the curve or the flattening of the curve or the lowering of the curve. So we didn't want to present something that became too noisy, but typically what we do is we plot our swaps and then we put in the swap curve. So I do realise that quite a few of you are sitting far away, so you might not really be able to see it. So the swap curve is where we have on the x-axis we have our 90-day rate, we have our official cash rate, and then we have interest rates for 1 year, 2 year, 5 year, and 10 year. And then we actually just plot at a certain point in time what is the OCR, what is the 1 year rate, what is the 1 year swap rate, the 2 year swap rate, and so forth and so forth. And effectively, what you get to see is that gets overlaid with effectively. So we take all of our swaps, and because we know it's got a term and we know it's got an interest rate, and we plot that. So we have effectively what's called a scatter chart with this curve. And you may have also heard we're either in the money or out of the money. So when the curve flattens or drops, which is when it effectively becomes below most of our plotted swaps, it means we're out of the money. And what that means is what Annalise has just said. That means our swaps that we've got on our swap book, if we were purchasing those exact swaps today, the fixed interest rate on those swaps is lower than what we bought them for back in the day. When the swap curve steepens or lifts up completely, whereby lots of our plotted swaps are below the curve, we say we're in the money, and that's a great place to be, because that means actually the market price of our interest rate swaps are higher than what we've purchased them for. So that's where we start to see again that accounting entry starts to show a gain. But generally speaking, if we made the decision that our policy we're not going to have a minimum of our we weren't going to fix a minimum 55% of our loan book, we weren't going to have swaps at all, then those swaps would eventually reach the end of their term, and we wouldn't have to do the swap curve. So as Wayne said, if we didn't have swaps, we wouldn't have these funny accounting entries. But the accounting entries would eventually equate to zero, because it's a timing difference. It's basically comparing our swap book to the market movement. So that's why it's called last night I said a mark-to-market movement. It's exactly what they're doing. It's our swaps are being plotted against the swap curve. So hopefully that makes a little bit more sense.
I guess trying to think about the accounting rationale for making you show that it goes back to those nasty traders overseas who did all sorts of bad things with derivatives. And they could be hidden if you're not forced to show them accounting-wise. Because the reality is we can actually close out a swap. We never do. Our policy wouldn't allow it. That would be speculative in nature. But I guess that's the thinking behind why do they force you to show these unrealised gains and losses. Because, as I said to you earlier, ironically, if we fixed on the day we borrowed, we would never have to show those accounting entries. And yet, we would still have borrowed at a higher rate than what we could borrow today. So nothing would be any different apart from the accounting entry. So that's where it's a little ironic. It's not really set up for the likes of us who take a position and stay with it. It's set up for those people who trade to have to show the gains and losses that they're making through getting in and out of swaps. So a little bit messy, but it is a reality. And just like other revaluations, we say, hey, it's down there. You need to know about it, but you just need to understand that it doesn't ever get crystallised.
So the only other thing to add is, so we look at our swap curve all the time, and it worries us when it drops, because we're very aware of that accounting entry and how the community may perceive that. So we're looking at our swap portfolio all the time, and last week at the Audit and Risk Subcommittee, we were talking to the subcommittee about blends and extends. So effectively what we're looking at that portfolio, we're looking at what the current prices of those swaps are today, and a blend and extend may be where you actually, so the banks will never lose. So we sign a contract with the bank, so we commit to pay a fixed rate for a certain period of time. But when the swap rates drop, we have the option of actually exchanging our swap for a longer dated swap. But because they aren't going to lose out on the interest they would have earned from that original contract. So if, for example, we wanted to buy a 10-year swap, if we were looking to blend a 10-year swap that we purchased in, for example, 2016, say we had that at 2% interest rate, and we wanted to change that for a 10-year swap that's sitting at 0.7%, the bank will make sure they don't lose out on that original contract. So instead of swapping for a 0.7, we may pay a 1%. So it's less than what we're paying for now. It's called a blend and extend. So, and the reason why that conversation came up is our weighted average cost of borrowings is 4.15% today versus a budget of 4.8. And the question was, why is your weighted average cost of borrowing not lower? And it's because of our swap portfolio. So you enter into swap contracts for a period of time. And in 2014, we thought that just under 4% for a 10-year swap was extremely good. Now it's just above 0.5%, but you're committed to those contracts for that term. So the word that was used that I really liked is we're suppressive. So we can't get the benefit of those lower cost swaps immediately. So even when we do blend and extend, we can reduce our weighted average cost of borrowings. But at the same time, we're also committing the council to interest rate swaps for a longer period of time. So with interest rates coming down, we have to think very carefully about that. So when you're bound into swaps, you can't get the benefits of falling floating rates immediately. So everything is taken into account. So lots of things. That's why we have lots of charts. That's why we have the policy, and we have to consider all factors.
What the policy then tells us is what's our limits of swaps that we can enter into. So we've got our major control limits. So basically the policy tells us you cannot actually enter into more swaps than your debt book. So that's the first major control limit. And then the next control limit is our fixed floating risk control limit. And the policy specifies that we need to hedge 55 to 100% of all our borrowings.
Sorry, Annalise. I just wanted to explain what we mean by a notional amount. So when you enter into a swap contract, so say for example we purchase a 5 million swap over a term of 3 years, there isn't an exchange of $5 million. You're actually purchasing the interest rate. So it's a commitment to pay for a certain period of time a fixed interest rate to the bank, and they will pay fixed, they pay us floating. There isn't an outlay of cash of 5 million. So that's why we call it a notional.
Because I don't know what you're going to say next. And it's my turn. You might think it's a real pretty basic observation, that top one, that we won't hedge more than the total of our debt. But it isn't quite that simple because, of course, every year we have to anticipate what will be the changes to our borrowing program. And there have been councils that have hedged in, because what we can do is today we could take a hedge to start in 1 year's time. Okay, and if we think that's the best way to do it, we could do that. The problem is that'll be based on debt that we think we'll have then. And if we don't deliver our full CapEx program, for example, we won't have needed to have borrowed everything that we thought we would. If something else comes along and the government happens to say, I'm going to give you $10 million to pay off your debt for, say, some assets, and that wasn't built into our program, we've now got $10 million less debt, and therefore we shouldn't have the hedge. Okay, so this is yet another complication in terms of anticipating what your debt will be. So while you might think that's really straightforward, so don't hedge more than your debt, we actually have to look ahead and make sure that our swaps match what we can anticipate will be our debt. Or if we have a level of uncertainty, we therefore should not look to get close to that 100%. Does that make sense? And that is why your bottom limit is more like 55%, and you will often see us sitting at more like 70% and leaving a little bit floating, because you cannot be 100% certain of your debt requirements in a year's time. You can be 95% certain, but probably not 100.
Just to continue with the information on the right of the slide. So just like with our borrowings, the policy tells you what's the term of your swaps. So it has your maturity buckets for our swaps as well. So if we look at it's 1 to 3 years, our maturity period, we need to have a minimum of 15% of swaps within that bracket and a maximum of 60. And then we've got the 3 to 5 years, 5 to 10, and 10-year plus. So it just gives us that discipline again to make sure that we actually look at the maturity of our swaps and we don't have all our swaps being in one bucket and maturing all at the same time. So for just general information, as at 30 June, our weighted average life of our swaps is 4.5 years of our total swap book. Our hedge percentage at the 30th of June is 92.3% of our borrowings are fixed through interest rate swaps. Average cost of borrowings is 4.15%, and that's down from last year's borrowing cost of 4.46%. And our average length of debt is 3.2 years. If you look at the next slide, this is really just showing the reporting again that we report back to Audit and Risk Subcommittee on our compliance with our maturity buckets. And as with our debt maturity buckets, it really just shows you what is falling into each one of those time periods. So, for example, 1 to 3 year swaps, the blue line, it's basically showing us that at June 20, we were sitting around 17%. And if you look at our maximum and our minimum should be 15% and our maximum should be 60%. And then you can just apply that then for each and every maturity bucket within our swap portfolio.
Thank you, Annalise. So our borrowing covenants. So COVID-19 has brought with it many considerations, particularly with treasurers. So over the next 6 years, we're well aware that particularly councils are facing revenue pressures. Our rate's going to be able to pay, developers going to be developing. So, pretty much the sector faces declining revenues over the next 6 years, and demand for investment in our infrastructure is just going to go up. So all councils have covenants over their the amount of debt they can take, how much of their debt matures in certain years, as well as the swap. So what we've presented to you is not unique to this council. It's across the whole sector. So and most of us are primarily obtaining debt from LGFA because it is the cheapest source of funding. So recently what's happened is the LGFA have put in what's called alternate debt covenants. So effectively they've raised the bar. So once you max out with the LGFA, if you breach the ceiling that they put in place, you can't borrow money from them. And with the shovel-ready projects, is it going to be a loan from the government? Is it going to be a grant from the government, or is it going to be a loan? So this all comes into play. If we're given the green light to go and do lots of projects across the country, how are we going to fund this? So as we've said earlier, that we actually obtain all our debt funding from the LGFA. So I'd like to just talk to you about some changes that have happened to LGFA recently, and in fact this is the main reason why we are actually presenting proposed changes to the Treasury Management policy on Thursday to the Strategy and Operations Committee. So so our preferred limit within our financial strategy is that our net debt is under 200% of our operating revenue. Now, the LGFA have their own debt covenant. They say that councils that borrow with the LGFA, they can't have their net debt exceeding 250% of operating revenue. And our Treasury Management policy actually says, well, our net debt can't exceed 240% of operating revenue. But our financial strategy kicks in and says, no, our preferred limit is to allow us some headroom within our borrowings to be able to respond to new projects or adverse market conditions. We set at 200%. So we can go up to 240%, within our Treasury Management policy, and as far as the LGFA are concerned, we can go all the way up to 250. But they've obviously looked across the sector and realised that there are some councils that are getting dangerously close to those covenants, in which case they can't borrow from the LGFA. So very recently, the LGFA had a I think it was an AGM, special general meeting, and they voted on that. And we took a paper through to council and actually recommended that we vote in favour of this, and we have done, and that's why it's now reflected in the draft Treasury Management policy for consideration and approval on Thursday. So what the LGFA have done is they've said, well, for the current financial year, or the one that we did have, the 30th of June 2020, they flatlined it and said that your net debt may not exceed 250% of your operating revenue. Now, every year, if we go back to one of the slides that Annalise presented earlier, so one of the reports that we have to do, or one of the monitoring functions, is we have to, at the end of every financial year with our audited financial results, we have to do a declaration with the LGFA. We have to actually confirm that we haven't breached any of the covenants. So for the 30th of June 2020, we may not have net debt exceeding 250% of our operating revenue. Now, there has been a significant step change. So for the current financial year, the LGFA have raised the bar right up to 300% to create headroom for councils. That 300% remains in place for the following 2 years, so all the way up to the 30th of June 2022. And then what happens is we go through 4 years where that covenant is reduced by 5% year on year. So our Treasury Management, so at present our proposed new policy reflects these alternate debt covenants, but we're still governed by our financial strategy, which is the preferred limit that we stay under 200%. So the policy allows us to go up to these limits. And as you can see, year on year we drop. So 30th of June 2025 is at 285%. And then what happens 1 July 2026, that drops down to 280%. So it's a further 5% drop, and that stays in place thereafter. So we ratchet up straight away to 300% for 2 years, hold, and then we come down year on year 5% down to 280, and we'll stay at 280, subject to any further changes that require that to be reviewed. We've added a couple of new slides. We're almost at the end of the presentation. We've added a couple of slides because yesterday we became quite conscious. We were talking about depreciation funding and non-funding over depreciation. So we had a couple of questions at the end of our workshop, and so we thought it would be beneficial to just talk you through depreciation funding and the depreciation funding gap, because that does bear relevance on our Treasury Management. So before I get into the slide below, so our depreciation is effectively treated as an operating expense which is funded through rates. So we work with the council and we determine what operating expenses we require for a year, and then so that equates to a certain amount, and then we actually look at our revenue streams. So we take off fees and charges, we take off subsidies, capital subsidies, and what falls out is the amount that we have to fund by rates. But that's putting depreciation into the mould. Now, at the moment, we aren't fully funding our depreciation. And the fact is, for every dollar of depreciation that we're not funding through rates, we are funding through borrowings. So this has been in place for a wee while, so we don't have a balanced budget. Because we don't fully fund our depreciation. And the decision was made because that relates to infrastructure assets that were relatively new and didn't need to be fully funded at the time because they were such new assets, but over the life of the asset we did need to play catch up. So our financial strategy has been geared at closing the depreciation funding gap. So our financial strategy is all about getting this council ready for the significant infrastructure expenditure that will be in years 2042 and beyond, where we have to replace significant parts of our infrastructure assets. So we need to get our debt down so that we can fund the renewal or a replacement of those assets. So behind me there's a chart which breaks down our borrowing. So we have been borrowing money, as I said, for every dollar of depreciation that we're not funding, that's coming through. We have to borrow for that. Right now we are not funding $3 million of our total depreciation spend. That's being funded by borrowings. So what we're showing here is, so this is the dotted green line is our green line strategy. This is where showing that our net debt must not exceed 200% of our operating revenue. So that's our control, and this is the charts are showing what our net debt is year on year. So this is where so for 2021, that's where we estimate our net debt's going to be. So the first thing we do is we compare that against our financial strategy limit. Must be below 200% of operating revenue, which you can see behind me it is. But what we're actually showing you here is we're looking at our debt book and we're saying, well, how much of our debt actually relates to not fully funding depreciation, and that's shown in the orange. That's shown in the orange chart. So what you can see behind me is that the debt that we've had to take on by not fully funding depreciation peaks at $50 million. And that is shown over there. That's the $50 million. So our financial strategy has been to every single year to just start to close the non-funded depreciation gap. We want to get to a point where we're fully funding depreciation. That means we aren't taking on additional debt. And then to start to rate fund surpluses so we can accelerate our debt repayments to get our debt right down to create the headroom for the critical infrastructure asset replacement in years 2042 and beyond. So this is just really showing us that, and so that's what not only do we need to model how much debt do we need for our CapEx program, but we're also modelling how much debt do we need to fund the non-funded depreciation. So this chart is showing it in a slightly different way. So again, we've got our financial strategy limit, the green dotted line. That's the 200%. Our net debt must be below 200% of our net revenue. And then we're just simply showing the blue lines is showing what our net debt actually is. So we can see from a compliance perspective, we plan to be below the financial strategy limit. This line there is showing you what's happening. That's representing what's happening to the debt that's been borrowed as a result of not funding the depreciation. And you can see that that's peaking. That starts to get up to 50 million and beyond. Now, the red line is actually showing how much of our annual depreciation are we not funding. And as you can see, our strategy has been to close that gap. And you can see we started off, so this on the right-hand axis, we're looking at that's in millions. So in 15-16, for that particular year, approximately $7 million of annual depreciation wasn't funded by rates. Instead, that was done by way of borrowings. And it's coming down, and for 2021, what we decided, we worked with councillors, and to keep the average rates increased to 2.6%, we decided not to increase the amount of depreciation that we're funding through rates. So we didn't close the non-funded depreciation gap anymore. But certainly in terms of our financial strategy, and that's had the impact, so it has allowed us to keep rates down to 2.6%, but it has prolonged how quickly it's going to take us to fully fund depreciation by 2 years. So that's what we're just demonstrating there. So our financial strategy is still aimed at fully funding depreciation, which allows us to pay back more debt because it reduces our amount of debt funding that we need. Yes.
So I want to just paraphrase all of that in my words. So from about 2006, every year for about 8 years, the council made a call to keep rates increases down by about 1% per annum. That was on average over those 8 years. because there's always that tension to try and keep rates increases down. And the argument that you've heard was, well, you don't need to fund those asset renewals for a long, long time, so you can catch up later. Let's not worry about it now. And this is where it comes home to roost. So if we had not done that over those 8 years, we would not have today $50 million of debt. So instead of around 160 million in debt, we'd have about 110 million in debt, and we wouldn't be feeling very uncomfortable. Or alternatively, in the last 5 years, we could have spent more on our CapEx program. And councillors who've been around the table for a while will know that for the last 5 years, what we've kept saying is you can't spend everything. We cannot. Our CapEx program is very, very low, totally focused on simply the crucial renewals and resilience work. There are no nice-to-have capital investments. And nice-to-have is even a generosity, isn't it, really? But so these decisions have long-term impacts, and it's like a slippery slope. That at the time it seemed reasonable, and year after year it got a little bit easier to do it. So now you can see the joint impacts of that. Wasn't really worth keeping rates increases down by 1% a year when you look at the impact it's got on us today. And we've spent the last 5 years trying to unwind that. Luckily, we're in a reasonable place come COVID to have been able to withstand those impacts. If we had not been doing that, we'd be in a much more dire position. If you go back to the 2013 long-term plan, I think our debt was going to be up near 200 million now. We would have had nowhere to go with the potential problems. So, you know, again, like we keep saying to you, you're trying to think ahead and allow for the unknowns, allow for resilience, and be prudent. It is going to take a further large number of years to pay off that 50 million that we borrowed instead of rate funding. So that'll peak at 50 million, and until we run a small surplus, we will not be paying that down. So it just goes on and on and on. It's a gift that keeps giving for probably the next 15 years. And of course, local government has to be set up to think that far ahead. But you heard Mark say that we've got significant infrastructure investment coming in the 2040s, likely, for all of our pipe networks, because they were built around 1978 to 80. And we have to be ready for that moment to be able to afford to do that work, let alone everything else that comes along. So really, this is the big insight moment that we would like councillors, one of them, to understand is that debt impact. Nobody wants high debt, but nobody wants high rates. Well, you can't have it both ways. So probably, I don't know if you're going to go there, guys, but up to 2% of the rates increases every year for the last 5 years has been closing the gap, unwinding that issue from a long time ago. And when people say, why are your rates increases higher than CPI? Significant reason is this.
So just finishing off our presentation, this is a very interesting slide. So financial instruments is a really, really technical accounting area. And all that I wanted to show is that we are heavily controlled by the accounting standards. So in the standards, it actually tells you what types of assets you have. So what we do on the table is really showing the types of financial assets and liabilities that council has. This is how the financial standard actually classify it as. That's the type. And this is the accounting that we actually need to do on each one of those types of instruments, and that's what we are getting audited on. Do we actually comply with the standards? And it brings us back to that derivatives, where this is the standards that's forcing us and making us do that entry. So it's very transparent to the users of our financials that we have these instruments, and this is what's the fair value of those instruments and the impact to council on our financial statements. But it's all driven by these accounting rules. So that was just a little bit to finish off on.
Thank you, Annalise. Are there any questions? So in that case, on behalf of council officers, we'd like to say thank you very much for attending tonight, and to our viewers that are watching our live stream, thank you very much. That's the conclusion of the second part of our three-part workshop. Tomorrow we are doing a workshop on our rating system, so we'll be explaining to you everything to do with our rates. So that does kick off at 5 p.m. That'll be live streamed as well. So thank you very much for attending, and we'd like to wish you a very pleasant evening. Thank you.